Hello, my name is Chris Casey, Managing Director with WindRock Wealth Management. Today is September 18th, 2014, and I'm pleased to be joined by Axel Merk. Axel is the President of Merk Investments, which owns and administers several currency-focused mutual funds. Axel is a recognized expert on the global economy, monetary policy, and international investing. He's an authority on currencies, and he's a pioneer in the use of strategic currency investing to seek diversification. And you've been named as he's a currency guru by Morningstar, which is a pretty cool title. Axel, thanks for being here today.
Great to be with you.
So I know that you're a German citizen and obviously a currency expert. So let's talk a little bit about the European Central Bank and the euro. It's been in the news recently. Earlier this month, the ECB announced they were cutting interest rates, I think increasing the rates charged on excess reserves, and also announced a stimulus package that some people are comparing to a QE3. Tell us about these measures. What is the ECB doing, why, and how do you think it'll shake out?
Sure, and just for clarification, we are California-based. All our investors are U.S. investors. I just retain my accent, so I'm considered an expert in the field of currencies. As you point out, though, my heritage puts me a little bit more into the Bundesbank camp as to what my bias is towards what the policy should be pursued. But ultimately, it matters very little what I think. It matters what the markets think. And we just had, for example, today, the European Central Bank launched the newest round of the TLTRO, a mouthful. It's a liquidity provision that had a very mediocre pickup. Basically, Mario Draghi, the head of the European Central Bank, is furious that the euro has been so strong. The reason the euro has been so strong is because it's done difficult to debase the euro, because printing money in the eurozone is not straightforward. In the US, the credit markets make the economy work. That's why when you buy treasuries, or potentially even mortgage-backed securities, you can do a lot of things, a lot of bad things, I would say, but you can influence something. In Europe, when you need a loan, you don't go to credit markets, you go to a bank. And that's the key problem Europe has. The banking system has a problem. And so it doesn't matter what sort of money you print, things don't really change. And so that shouldn't stop Draghi, so he's been trying to talk down the euro. And importantly, much of what the European Central Bank has historically done, it's about to change, is a demand-based liquidity provision. So rather than printing a certain amount, they just provide the liquidity. But as the most recent liquidity provision shows, the banks don't want it.
When you say it's about to change, are you referencing the interest that they're charging on the excess reserves, or what exactly do you see changing?
Well, the interest on the excess reserves was one of the attempts to weaken the euro. Now, keep in mind, there are no reserves parked at the European Central Bank anymore, and they haven't been for a while. So these negative deposit rates don't really affect anybody. It's the signaling that rates will be lower for longer that weakens the euro a little bit, although if you look at real rates after inflation, they're more negative in the US, and the gap is widening because in the US inflation is picking up at a faster pace, and so on a real interest rate differential, the US is much worse off. Now, the next thing that Draghi then did is, all right, he is going to buy asset-backed securities. The problem is there's no ABS market. In 2008, that market died off. And so not to be deterred, the next thing he wants to do is to buy covered bonds. That's a European specialty, and yes, there is a market. The only problem is there's no problem in that market. And so with that, he can lower the yields maybe a little bit for everything, except, of course, the stimulus that Europe has had is to have Spain, rather than pay 7%, pay less than 2%. The cost of credit is not the problem. It's the defunct banking system. And so the only thing as Draghi has achieved is weaken the euro. But, of course, that may be precisely what he wants to achieve. So he's getting a little bit of what he wants, at least for the short term.
And do you see the euro continuing to fall?
Well, in fact, I happen to think that right now the euro is far more dependent on what's happening in Russia and Ukraine. When Germany starts to impose sanctions on Russia, and you have a tit-for-tat in sanctions, it does destroy the little bit of confidence there is in Europe, Northern Europe in particular. That is far more detrimental. Now, in the very short term, and by the time you air this will be passed, but in the very short term, Scotland has been driving the euro lower a little bit. The short of it is the euro bulls, of which we are one of them, or have been one of them, we're not buying. It's because there are too many uncertainties out there. Whereas the euro bears, they're piling in. And at the same time, I'm just waiting on the sideline. I'm very glad that the euro has been on sale, that the sterling has been on sale. And I've been reluctant to buy the euro, but I've certainly piled in on the sterling. And in my view, and by the time this is aired, we'll know better. But in my view, the odds are very, very high that this referendum is going to be rejected, and at the very least, that's going to be a relief rally for the sterling. And these currencies are very tightly linked, and so the euro should also benefit with that.
Well, you mentioned these rounds of sanctions over the Ukraine with Russia. Will that be a catalyst, or there's some other potential problems there that can push some of these economies over the brink and really bring them back into a recession?
Well, sure it can, but at the same time, I don't think that forecasting GDP growth or shrinkage by the second decimal or so is going to get any investor any further. We like to look at it kind of from a much broader point of view of what's happening and why are these sort of things happening. People are dissatisfied. Not just in the US, where we've had the rise of the Occupy Wall Street movement or the Tea Party, Middle East, where we have revolutions, in Japan, where you have a populist prime minister. What they all have in common is that real wages haven't gone anywhere. Governments have too much debt. And when that happens, it grinds on people. In the Middle East, where the cost of energy and food is actually a big part of their disposable income, you start a revolution. Here we just veer towards more populist parties. In Scotland, they're going to the poor neighborhoods where people are upset. And of course, who are you going to blame? You're never going to blame yourself. You're going to blame minorities. You're going to blame foreigners. You're going to blame the wealthy. And so what we see is a deterioration of political stability, of social stability. And in that sort of environment, populist sentiment is rising, and it expresses itself in different ways. And so that Ukraine can't balance its books. It doesn't matter whether they're associated with the West or the East. Those problems are not going to go away. Similarly, Egypt, they need a good chef that can feed the people. They don't need democracy. And as long as we don't fix those underlying problems, which isn't happening, by the way, we're going to continue to see these issues. The difference is in the US, we have a better ability to kick the can down the road than in many other countries. And so the dynamics are a little different depending on the region of the world that you're looking at.
Sure, and you'd mentioned debt, and obviously the debt situation in the U.S. is terrible. I mean, we're over at 100% of official debt, federal debt relative to GDP. But what about these European countries that are even in worse shape? Whether we're talking about potentially France or some of the smaller countries, Portugal and Greece, how are they able to command lower interest rates right now than U.S. Treasuries?
Well, with the happy support of a printing press, right? I mean, that's really what happens. And ultimately, I think we all agree that there's a lot of debt out there. And so I think it was a Newport Beach-based fund management firm that once said, contracts will have to be renegotiated. Meaning, if you have too much debt, you got to deal with it somehow. You can do the honest thing and say, I can't pay it. You can default. You can try to raise revenue, raise taxes. You can cut expenditures. Oh my God, we don't want to go that route, right? Mm-hmm. Because that's too painful. Or you can inflate your way away. And there, in the US, I think we are better able to inflate our way out of it. The Europeans have fiddled with austerity. Structurally, it's much more difficult to induce inflation. The Japanese have shown after World War II that they can certainly inflate their way out of this, and they'll pursue the same path. And so there are investment opportunities depending on where one goes in that chain. Now, back to your question, of course, how can you demand that low a rate? A central bank can always lower the cost of borrowing in the short term, but there is a valve. When you fix prices, and that's what setting interest rates are, something has got to give. Now, currently, because none of this money sticks and because nothing is really moving, the velocity of money is low and so forth, we haven't seen many of the bad side effects. The biggest threat that we are facing throughout the globe is economic growth. And the reason I say that is that the cost of borrowing should go up as the economies pick up, should that happen. How can the Japanese finance the deficits if they really succeeded with Abenomics? But similarly, we say in the US, if economic growth picks up, tax revenue picks up. Well, how can we support our entitlement expenditures if interest rates are to go up? If you look at the CBO projections 10 years out, if we go back to the historic cost of financing our deficit, we'd be spending $1 trillion more a year just to pay interest on the debt. Now, fear not, that's unlikely to happen because the Federal Reserve is going to step in, keep the cost of borrowing low, and as a result, well, the dollar might just suffer in the process.
Right. It's interesting. One of the things I was thinking about is this latest move by the ECB seems somewhat in contrast to supposedly where the Federal Reserve is going. And I know that Draghi, I think, was, as I recall, a classmate of Bernanke's, or they somehow knew each other from a long time ago. Is this a divergence in the two policies of these two large economies, or are they still coordinated to some degree?
Well, everybody wants you to believe that the Fed is on this tough exit path and the ECB is on this amazing weakening path. But if you look behind the scenes, things look a little different, because I don't see that exit in the U.S. Janet Yellen has all but promised to be late in raising rates, and the rates that count are real rates after inflation. And forget for a moment whether the inflation indicators are accurate or not. I happen to believe that they're a little more accurate in Europe than here, but still, real interest rates are more negative. Real interest rates have been declining. If we're going to wait another 9 months or so, or 6 months before we start raising rates, and they're going to be at, if we look at the projections, economists say we're going to be at 1.5%, let us be at 2% at the end of next year. That means real rates are going to continue to go down. Contrast that with Europe, where real rates are just slightly negative and have been stable at that level. And now, of course, Draghi promises to print some money to mostly weaken the euro. If you go through his math, and I happen to agree with some of that, you're going to get a little bit more inflation, but you're going to get far less inflation than in the U.S. So if you combine the two, I can't subscribe to that philosophy that somehow in Europe we're going to be so much more dovish than in the U.S. But that's the perception right now. And the good news is that there are some opportunities, of course, here. The dollar has been on this relentless rise, on this perception. I happen to think the U.S. economy isn't quite as good as people make it to believe. I happen to believe the European economy isn't quite as bad. If you think about it, in Europe, you have an 11% unemployment. Well, that's a tremendous opportunity to still come down with the unemployment. In the U.S., we're close to full employment already. And clearly there are plenty of folks who don't have a job, but the reason they don't work is because they got Medicare. The only reason why they started to work in the first place is because they needed to get health insurance, and now when the government takes care of their health insurance, why would they work? So these guys are not going to come back to the workforce.
Or they're on disability,
or something like that. And so they have a disincentive to work, and which means the folks who are left working at some point will demand higher wages. The Fed is substantially behind the curve. That doesn't mean things are great, but we will get inflation way before we can pick up. And by the way, if our new normal is indeed 2%, that's where interest rates are going to be heading in, we're going to be living in a persistent state of financial repression because real interest rates are going to continue to be negative.
Mm-hmm. Well, I think we certainly agree with you on the Federal Reserve that it's more a facade than anything, the so-called tightening that's been going on. And I think Casey Research has done some good things about publicizing the reverse repo market and how they kind of build up a war chest of potential liquidity that they could unleash.
Well, the reverse repo market is one of the tools they use to try to tighten. And we monitor the facility quite closely. It's gone beyond the testing phase. They haven't deployed on a big scale. But you already see money market funds, for example, they use it for window dressing. And when they publish their holdings every month, they need to be invested in something. And the reverse repo facility is a very convenient one, especially since one of the things that all these Fed action is achieving is they're killing off parts of the commercial paper markets and other markets. And so that facility will be welcomed by institutional managers such as those managing money market funds.
Mm-hmm. So where do you see the U.S. stock and bond markets headed? And given your opinion on the euro and the Europe and what's going on with the dollar?
The one thing that central banks have achieved throughout the world, there are a lot of things they haven't achieved, and we can go into that. But the one thing they have achieved is they have compressed risk premium. Now that may sound very academic, but risky assets don't appear risky anymore. Junk bonds don't yield anything. Bonds in Portugal don't yield anything. And for that matter, the stock market, the VIX index, the volatility index is very low. So you have people pour into the ultimate risk asset, the stock market, on the backdrop of lower volatility. Now what that means in plain English is that investors are not aware of the risks that are typically in these markets. So when the volatility goes back up, they will be gone in a heartbeat. You saw that when the Scottish sentiment suddenly, one survey showed that they want to reach for independence, and the sterling is one of the most boring currencies, and it flares up, becomes one of the most volatile currencies. Now, the reason I mention this in this context is that if indeed the Federal Reserve tries to engineer an exit, even if they don't gone very far, it means that risk premia will rise again. It means that because central banks are taking the foot off the accelerator, that assets will have to be repriced. So unless there is another extremely good reasons why stocks and bonds should be valued how they are, they have to be repriced. And that's why, and that can happen in a vengeance. On a technical basis, by the way, historically you have short sellers in the market. Those have all been chased away from the markets because short sellers haven't made any money. The good thing about short sellers is they have to cover their short positions once in a while. Well, if you have some technical barriers be broken and somebody dares to sell some stocks, everybody's going to pile in, and the natural buffers to prevent that from just leading to a crash are not there right now. And so I am extremely pessimistic about the stock market right now. And if anything, even if you're not as pessimistic, you may want to take some chips off the table, because the time to take chips off the table is during the good times, not during the bad times.
Well, tell us, obviously, you're a currency expert in your funds, several of them at least specialize in currencies. Tell us a little bit about Merk Investments, what the funds do, what your outlook is, and how you measure the value of various currencies, and just kind of procedurally how you go about managing the funds.
Yes, so we manage 4 currency mutual funds. We also manage an exchange-traded fund, the Gold ETF, OUNZ is the symbol, which is a competitor to GLD with a key difference that investors can actually take delivery of the gold. We can go into that. But without going into too much detail, 2 of our funds are funds that, if you believe we have a better printing press than the rest of the world, that might be suitable. A hard currency strategy that gradually shifts in the developed markets, with the idea is that you diversify out of the dollar and you try to pick up a few opportunities here and there. And unlike shorting bonds, for example, which can be very expensive, if over the long run the dollar depreciates, you might be able to come out ahead. We've beaten the dollar index in that fund every calendar year. We've been around since 2005. Last year we were praised by the Wall Street Journal for being the brave ones to predict the euro would be the best performing currency. We were lagging last year for the first time because the euro has such a huge exposure to the dollar index. We have the Asian Currency Fund, a managed basket of Asian currencies. It's primarily a play of a rising renminbi. Then we have what we call as our currency war strategy, our absolute return currency fund, which is a tactical strategy. The key attribute of the strategy is that by design it should generate returns that have a low correlation to other investments. If everything goes up in tandem, everything can come down in tandem. So you're looking for diversification. The other thing that people are not aware of, that currencies are actually not as volatile as they're meant to, as they're thought to be. When the euro moves a full cent, on a percentage basis, it's not all that much. And in a long-short absolute return type of strategy, think about going long the Australian dollar, short the New Zealand dollar. Well, you're offsetting the risk of one currency with that of the other one. So the risk profile is actually rather compressed, only slightly higher than the bond fund. And so many people move a bond allocation to the absolute strategy. Then we have a strategy that combines that with an equity strategy, a currency overlay strategy, and we do some hedging with the underlying equity portfolio. So in a nutshell, what it is that it's an equity strategy, mostly following the S&P, but what we do is that with the additional alpha that we try to generate, we buy some protection, we buy some put options on the equity. So it's a bit more complex, but the idea is that if there's a downturn in the equity market, the downside can be buffered. And then we have the gold product, because as much as we love currencies, many people think, oh, that's too archaic, too complex. Gold, people know, understand, they like it, they don't. We think we have a better gold product than what's out there in the market, and it's been getting very nice traction in the market.
And it fits right in, because it's historically gold. I mean, gold is money, so it fits right in with the currency.
Well, absolutely. Yeah. And to just mention that just in a little bit detail, we hold London bars in London, just like other ETFs do, with a difference that you can take delivery of the gold. And not only can you take delivery of the London bars, you can specify that when you take delivery, you'd like to have it converted to coins. We had somebody the other day order 54 American buffaloes, and it took a good week for that delivery to take place. Some in the media said, oh, it was expensive. They paid 4.6% because there was a premium you have to pay for the delivery service. but if you go to a local coin dealer, we looked it up, the cheapest we found was about 4.4% premium, so
Sure.
it's very competitive. Importantly, it trades like an ETF. The spread in the market is 1 cent only, most of the time, has been anyway. And then, one thing many people are not aware of, taking delivery of your gold is not a taxable event. And so if you like GLD or IAU or any of these other products, but down the road you like to own the physical, you'd have to sell it, potentially pay tax, take delivery. With our product, you can just call us up and say, hey, deliver the gold. And that in itself is not a taxable event. When you ultimately sell your coin, then that's a different story. But the taking delivery is not taxable. And so we think that you get more than you get with the other ETFs. And that is something that the investors have appreciated for a lot and have been waiting for a long time. And we launched the product only in May.
Well, that's a good point. You had mentioned the Asia fund. I was curious because one of the things that's in the news quite a bit over the last year or so is the U.S. dollar's diminishing use as reserve currency throughout the world. Where do you see that headed? Do you see that trend continuing? Do you see another currency rising as a reserve currency down the road? Because historically, I think, and you know this far better than I do, but over the last 400 years, every 100 years or so, there's a new currency that takes over. Whether it's the British pound and then it becomes the American dollar, etc. So, is there a new reserve currency out there? And if so, what do you think it'll be?
Well, think about a frog in a boiling pot. These things happen slow and gradually, but they do happen. The reason why people like the dollar is for 2 reasons. A, because you can take your money out. You're going to be very reluctant to put your money anywhere if you can't take your money out. And B, because of liquidity. One of the advantages of having so much debt around is that you can deploy $1 billion very easily. And the US is the only game in town for that. None of the other markets have the depth of the US markets. At the same time, when the Chinese want to buy something that's actually useful, like an oil company, Congress tells them no. And so the Chinese woke up and said, well, maybe we should diversify our assets a little bit. And so they've been buying real assets elsewhere in the world and doing other things. But you cannot buy $1 billion worth of forest or whatever it is, or other or mining or whatever it is in a short time. So it takes a while to get operational experience on how to deploy your assets elsewhere. The Eurozone had some big challenges, and that has made it more difficult. Some of that has gone away because now with Mr. Draghi promising he'll do whatever it takes, it is okay again to diversify to the euro. But those are some of the reasons why these things happen gradually. And then once in a while, the dollar rises for a few weeks, and people say, see, by the way, the dollar is just fine. It's just if you take a step back and look over many years or decades or longer, well, we just have a better printing press than many other people out there.
Mm-hmm. By the way, I think I read all your publications, and I always listen to all your podcasts whenever you're appearing. I have to ask one question, because I don't think you've ever addressed it. Have you ever commented on Bitcoin, and what are your thoughts on Bitcoin?
Yeah, because I get asked about plenty enough in other shows and other programs, so I don't talk about it too much myself. I think Bitcoin is a fascinating technology. It is not a currency. And if United frequent flyer miles were traded in a Bitcoin-like technology, it would be amazing. A decentralized ledger. But as a currency, it's mostly a prepaid debit card that fluctuates wildly in value. And so there's going to be some application. In fact, if the Bitcoin ETF comes to market, it addresses many of the shortcomings it has. Of course, the true Bitcoin lovers hate some of those shortcomings being overcome, but basically, if you're going to be successful, you're going to be regulated as much as you hate it. And the one key deficiency of Bitcoin is it doesn't comply with AML, with anti-money laundering laws. And so with that, it's very, very difficult to kind of become mainstream. And if it were exchange traded, the reason why that issue goes away is because you're buying them Bitcoin through your broker, who does all the AML screening. So that's going to technical levels here, but the short of it is that what Bitcoin is very good at, it's a good starting point to talk about fiat currency and so forth. But when you ask me what might be the next question, what's the better store of value, gold or Bitcoin? Now the Bitcoin fans will tell you Bitcoin. my answer is, well, if you want to store something for 100 years, would it rather be in gold or in Bitcoin? I much rather choose gold. We can't even watch some movies that were recorded digitally a decade ago because the technology is changing so much. Now, the Bitcoin folks disagree with that, but I stand by it. Now, Bitcoin, of course, is much easier to transfer things than with gold, which you physically have to move. So, of course, there's some advantages to Bitcoin as well. It's a great movement. It's a great technology. It does not rise to the level of a currency at this stage, though.
Okay, great. Well, I do, as I mentioned, I think you have a monthly publication called Merk Insights, which I read on a regular basis. I know you do a lot of podcasts on behalf of Merk Investments. If people want to get on that mailing list to receive that information, they want to receive Merk Insights, what's the best way to contact you? Or if they just want to learn more about your various funds?
Sure. Well, come to our website. We have a couple of them, but come to merkinvestments.com, merkinvestments.com. You can sign up for a newsletter there. Follow me on Twitter. Twitter is one of the best sources where you to get real-time interpretation of what's happening. Follow the folks who you believe are of interest and who provide something relevant. So that's one place I do tweet periodically. But other than that, yes, merkinvestments.com is you can sign up for our newsletter, and from there are clicking points to get our mutual funds as well as to our gold product, our ounce.
Great, and I highly recommend everyone to definitely check out Merk Investments, and some great information you guys put out. Well, thank you very much, Axel. It was a pleasure having you here, and thank you.
Yeah, my pleasure.